Welcome back, my passive income investors alike. In this video, we're doing a comprehensive review of my passive income sources. We're talking that $133,000 dividend stock portfolio, my YouTube Google AdSense income, and the recently launched passiveincomeForDummies.com, our Shopify store. The goal behind this video is to show you guys what is capable out there, as I am currently generating $700 to $800 a month off the cumulative income. And ladies and gentlemen, I look so forward to breaking all of this down for you. So let's just jump right into this. All right, getting into this, we're going to start with the YouTube channel. Then we're going to review the individual products on the Shopify store and what exactly is selling the best. And then finally, we're going to move into the dividend stock portfolio, looking at the individual income of each company. But getting right into it, starting with Passive Income Investor, my YouTube channel I recently launched as of January 1st of this year, has finally got approved for Google AdSense income as of last month. And this came from posting a video a day on the obviously finance niche, talking about stock market investing. And even as I sit here now, we have 739 wonderful investors out there learning some knowledge. And if you guys enjoy the content I post, consider slapping a like, because it's you 1.3K subscribers out there that have made all of this possible. And I learned just as much from you as I hope you're learning from me. And I think it's kind of funny that the moment I go to make a video on this, YouTube is doing maintenance. But nonetheless, we can see a lot of the metrics just to give you guys a good overview and 100% honest overview of the channel, as currently we are generating roughly $150 a month, considering we're not through the end of December yet. And between the beginning of last month and this month, we're almost at $300, which isn't a lot in the beginning considering the work I put up front, but it's the fact that I'm sitting here working on a video while my videos are generating income, which would be starting to make it passive income. So moving into the store and the recently launched Passive Income for Dummies, I partnered with Matt Money, another awesome YouTuber out there, and we kind of brought our combined knowledge. So taking a look at the current products we launched, we'll start with the best seller of the bunch. That would be our stock portfolio tracking tool, which is a spreadsheet on iCloud that Matt himself put over 24 hours into, that you can access on your PC or from your phone. And the thing that's so awesome about this is you don't need to worry about you losing your phone or anything. It's just on the cloud itself. And I think there's a big hole in the market for this, just because if you look at most of the platforms that exist, and I use multiple platforms for investing, they don't offer a huge amount of tools to actually properly track your portfolio, allowing you to see your diversification in your dividends, your portfolio, along with tracking some of your other income if you so choose. And this is an automatic tracker that he put together, and it's mainly focused on like US and Canadian, but we're looking to spread it out into further Forexes. And as I sit here, we recently just sold one of these charts, and we've gotten kind of a consistent viewer base going on this store as we speak. But moving forward into our other best-selling product, that would probably have to be our chat group. So what we did was we went ahead and we launched a chat group on WhatsApp to try and bring the community together, because a lot of us want to personally engage and learn from each other. And we currently have roughly 22 or 23 members, and this is probably one of my favorite parts of everything, because it's where I actually get to engage with people. I really love this part of our products. And then finally, we brought together a combined amount of all of this, including private videos that teach you about stock market investing that we actually add to bi-monthly. And this is our stock market investing curriculum, where essentially you get the combined products on the store. So you get lifetime access to the chat group, and then on top of that you get the spreadsheet. And then when you get bored and you have time to sit down and you want to absorb knowledge, we put a lot of work, like there's about 5 or 6 hours of just videos that currently exist. And I recently just posted one today on what I personally look for in the stock market when I'm picking individual companies. I show you good companies and why they're good, and then I show you some bad companies and why I think they're bad, and how to further deep dive into them. I really love this course because I don't think there's a course out there in the stock stock market cheaper than this for the amount of value that we provide. And in light of that, I know I'm just selling myself here, guys, but I wanted to offer this to you at the best value possible. So I went ahead and I recently made a basically a discount code, and it's Passive Income 2020. So if you guys want to experience this, it's a 50% off coupon code until January 1st, which basically gives you the combined two products. So literally the combined product here of the chat group and the chart for cheaper than you can buy just these two products together. Because if you get the stock market curriculum, it's only going to be $50 at 50% off. So it's like you're getting all of the videos for free and also a bit of a discount if you were to buy these individually. So now that I'm done selling myself, guys, this entire stock market course and store has been generating us roughly $150 each, or about $300 a month in income. And I really think we're offering a lot of value here. And I'd love to know what you guys think about this. And especially if you own a Shopify store yourself, I'd love to see the products that you are selling, as I think this is a very interesting niche. I'm going to continue into 2020 and expanding it further. So taking a look at the stock portfolios, before we look at the individual positions, I think it's fun to look at the performance update, as this only goes up to December. We haven't had the full month of December yet. And I think after the month of December going into January 1st, I might have had my first 100% return on my tax-free savings account. So what this chart represents is the cumulative income of my dividends along with the equity growth in my combined portfolios. The little black line represents the recently launched RSP account. The orange line represents the longest standing account, my managed account, which has been around for more than just over 5 years now, and then my tax-free savings account. And as of going into December, we had an 86% return on the TFSA. We've had a 71% return on the managed account, and the RSP just had a 5.34% return. Now, mind you that the RSP is a lot newer compared to the S&P 500, but if we were to compare it to the S&P, we'd probably be over the couple of months roughly on the same performance line. But over the same time period, the S&P is up about 56.78%. And this is just from roughly June 2017 to November of 2019. So that's within that outlook. Now, this is really, really cool because this really helps me understand going into the future. For as long as I continue to outperform the basic indices, I will continue to be buying individual stocks. And it's also fun to take a look at the performance in comparison on these each individual portfolios. As my TFSA, we can see month over month where I've had insane rates of return. And it's nice to see that when the market was underperforming, whereas the S&P would be down, say, as of what month was this? I'm not sure exactly. This was somewhere in January or February of 2018 when this S&P dropped a whopping 3.89%. My portfolio only saw a 1.1% dip. And it's kind of neat to see how my portfolio really tracks the S&P over time. And this would be because some of my biggest holdings include Apple, Microsoft, J&J, and I also have some really big dividend players in there, which is probably why when the S&P takes major dips, I kind of don't take as severe dips because I am collecting a large amount of dividend income over those months as well. But taking a look at the actual accounts, let's start with the TFSA, which currently sits at almost $98,000 as of this moment. And we can see the individual positions on the Canadian end. I'm still holding my two Canadian banks. We have my favorite utility and one of my first ever purchases in the stock market, Northland Power, which is a monthly paying utility. We got one of my favorite Canadian REITs, which pays monthly. And then on the US equity side, we obviously have my newer positions purchased, which would be like MO and BTI, along with GEO Group, one of my worst performers, but is recently starting to come back with a bit of a vengeance. And then we have obviously my tech sector. We got Apple, we got Microsoft, and my final utility in this portfolio, Southern Company. Now, the reason I like this portfolio so much is I mainly focused on only holding dividend stocks. Because this is a tax-free savings account, I generate tax-free income, which we're going to take a look at in a second after taking a look at the other portfolios. We're actually going to see the income that these are generating for me and the yield on cost I am achieving. But moving into my other managed account, which is, I call it a managed account because I move money in and out of this portfolio on a regular basis because I have to pay taxes and things of that nature. This is just a regular standard account, which currently I'm only holding MO in, which is up a little bit. I was hoping to see some more capital gains this year on this position within this account, but I'm not complaining overall, collecting a huge yield that MO offers. And then finally, my RSP account, I recently transferred in about $20,000 this year, or the exact amount of $20,300 $38, which I'm currently seeing a huge capital gain on. I mean, we're talking about an 18.65% return already, and I only just started investing in this account not even a couple months ago, and that would probably be because of my load up on Tesla. I also loaded up on Johnson & Johnson. And then to compare myself to the indices, I had to buy a little bit of VFV, which is an S&P 500 index. This portfolio directly represents how I want my overall portfolio to look, which is the combination of growth, stability, and long-term outlook. So what I say by growth, stability, and long-term outlook is, I mean, I want long-term focus, so I like having a nice stable index. And then on top of that, I still want dividends, which offer a nice form of stable income, which is with J&J, but I also want to experience some growth, which is why we buy growth companies, and I like Tesla as a growth stock. And if you look at my entire portfolio, it really represents that. Is some of my growth companies include Apple, Microsoft, where some of my dividend stocks would be more of the utilities and the REITs. And I think this is the healthiest way to structure a portfolio. As we can see, the structure behind this has obviously allowed me to outperform the markets. And like I said, if you guys consider subscribing, as soon as I get my final portfolio update for the beginning of January for the entire year of 2019, it's going to be really cool to see, because I'm really confident my tax-free savings account will be very close to seeing that 100% return mark, which is going to be something absolutely amazing considering I've only been investing for 5 years. Now, taking a look at my final account is my RBC account. This account is a new account I launched. It is just a regular trading platform where we can currently see I've been buying along with British American Tobacco, but some more MO, these sin stocks. I just couldn't get over the discounts that I consider these companies to be on, and they were my core focus for this entire year. And I finally kind of finalized the positions, and I will not be purchasing any more of these companies, but they were nice companies to kind of plop into my RBC account. Because I have to pay tax on these companies, I like the fact that their dividend yields are much higher, which we should probably take a look at. So before we get into those stocks themselves, let's just take a look at the tax-free savings account income. As of year to date for the year of 2019, we've seen $2,613 come in on the Canadian side and another $620 on the US side. Now, obviously, this is just for this year, and we still have, I think, a little bit more income coming in. But as I have increased my dividends this year substantially, going into 2020, we should be seeing almost a $2,000 return on the Canadian side, along with an $1,800 return on the US side. I am not too sure why the income looks the way it looks right now, because I'm pretty sure I've had a lot more US income. That might be due to the fact that I had to open up US accounts this year. So I'm thinking that the reason it's a little skewed is because when I would get US income, it would get converted to CAD. But going into the future, we can see I'm utilizing a US account and a Canadian account, which off my Canadian stocks, taking a look at the Canadian banks to begin with, we can see I'm getting about almost a 4.93, roughly a 5% yield off Canadian Imperial Bank and a 4.77% yield off Bank of Nova Scotia, almost generating $1,000 of income just between those two banks, which are paid quarterly, and our next payments are coming in January. Actually, we have a lot of payments on the Canadian side coming in January, as we can see, as we're getting about $326 and then $128 on the US side. But my favorite companies, Northland Power and RioCan on the Canadian side, because they pay monthly dividends, and I'm getting just over a 5% yield. My goal with the overall portfolio is to roughly get somewhere around 5%. But moving into the US side, we can see we got Apple and Microsoft being my tech companies, giving me a really incredible yield right now, as I'm almost getting 2% off Microsoft and 1.8% off Apple. The recent run these companies have been on, their current yield is roughly around 1% or less. So I'm really glad I got into these companies when I did, and especially considering they've been increasing the dividends. I think in a few short years, we could be seeing this get somewhere between a 2 and 3% yield, which is why I bought them, and I'm so happy that I did. Now, looking at the recent purchases, British American Tobacco, just within the TFSA and MO, we are getting roughly just over 7% on each, which is absolutely staggering is that is almost market weighted returns alone just off the dividend yield. And off the combined total of these two companies, we're bringing in roughly, 850, 860 USDs, baby, which is what I like to see. And then finally, taking a look at my other REIT and my utility, GEO Group is one of my worst performing stocks this year, currently paying an 8.8% yield. I am going to be leveraging in a little bit more of this going into the beginning of the year because I'm not done finalizing it, as it's probably one of the smaller positions, and I will also be filling up a British American Tobacco. And I still want to purchase a little bit of Southern Company, but just because it's been on such a run lately, I've been really hesitant. And unfortunately, all of my US companies do not pay monthly yields, but luckily it's fairly dispersed at this point. It's still relatively staggered by the looks of it, actually, and I probably should further diversify. As we can see, going into March, the income is looking pretty bleak. Along with February, it's a little choppy as well. But I mean, we'll continue to, as we scale the portfolio and buy other companies, this should probably continue to average out over time. But moving into the managed account, we'll start with the RRSP account, then we'll take a look at the managed account. In this account, we're not getting nearly as much dividend income because we hold Tesla, and obviously the Vanguard index doesn't pay nearly as much in dividends either. But luckily we got some J&J, and we're getting a really healthy dividend of 2.83%. Equaling $153 a month, with the combined total off this account coming into 2020, we should be seeing a combined total of about 200, just over $240 in income, which bringing into the combined total is really, really nice, considering that this is tax advantaged account. Mind you, I can't just pull these dividends out without paying penalties. It's nice to see that this money is tax deferred nonetheless, because if I were to pay taxes on this income, the government would probably be taking my entire Tesla position. The managed account has seen a lot more dividends as I've been moving stocks in and out. We can see we've achieved $921 this year, which will be taxable income, but because I transferred a lot of it into the RSP, I shouldn't be really paying any tax on that income. And the only company currently paying dividends, which will be sold, I will be using this capital in the future, so I will be leveraging down in Altria Group from here on in, but in the meantime, it's currently generating me $540. And that's also why we can see in the charting that my managed account is very choppy, because there's times where there's no money in the account and it currently will just flatline. Pretty incredible to see that the cumulative income is roughly, if we go back into my charting here on the overview, we can see we're getting about $440 a month, which isn't 100% accurate. Like I said, I have to go in and further update this, but it is quite accurate considering it's only about, I think, $5 or $10 off. And I also like to come in here and see the diversification within the income. We can see within the consumer discretionary, which I would relate to MO and BTI being some of my larger positions I built this year, we can see it makes up a huge percentage of my total dividend income, but on the portfolio value, it only makes up about 24%. I try and not let any individual sector make up more than 30%, and I try not to make any individual company make up more than 30% of, combined total on sectors of income more than 30%. So going into 2020, as I continue to add capital to the portfolio and the dividends get reinvested, I'm going to be further diversifying into REITs. I really want to start building out the REIT sector of my portfolio, as it currently only makes up not the hugest amount. I think we're looking at roughly 18%. So I really want to focus on bringing that income up, because REITs usually pay monthly as well. And going into my 2020 goals, ladies and gentlemen, I'm really going to be focusing on diversifying away from the stock market, and I want to continue building out my passive income sources with online real estate, as I call it, or buying online businesses. So I've currently been building a network of individuals that would want to build online businesses and purchase online businesses. So I will be kind of leveraging slowly down in the stock market by not actually selling positions, but basically cutting back on personally just adding as much capital as I am, because I think I can get a higher rate of return by personally managing businesses, and they are a lot less, managed and time intensive than an actual, say, business where you'd have to show up to a 9 to 5 or something that requires you to show up for a service. These are the kind of businesses where you put a lot of work up front, and then you're hopefully able to maintain a income off basically building funnels. So this is where a lot of my focus going into 2020 is going to be, but don't get me wrong, I'm not done buying stocks. I'm just, with where the stock market sits, there are always always deals. I always believe there are deals out in the stock market, but just currently where the S&P 500 sits and where stocks are sitting, I mean, even taking a look at Apple, if we pop Apple stock open here, we can see that Apple stock is trading at a PE it hasn't seen in a very long time, a PE of 24. And we have to remember that Apple was trading at a PE of 15 roughly at the beginning of 2019. I think it was between 15 and 18. So all these big companies are trading at very high to what they used to be valuations. So I don't want to continue just throwing money into everything that is currently up, but I do want to continue averaging in because obviously my goal is to continue to be buying stocks over the next decade, and I'm never going to cut down on that. I would just rather try and build up income sources, considering the income that I'm making off YouTube and this website would be the equivalent of having almost $50,000 invested. I think it's an incredible place to focus, and it will also allow me to have further capital to further invest into stocks. So this has been a very intensive video, and I really hope you guys enjoyed my breakdown and some of my future outlooks. So consider subscribing and letting me know what you think in that comment section below. This has been a really awesome video, guys. So I hope you enjoyed it. Stay cool, stay awesome. I look forward to chatting to you all real soon.